Dennis Jones is my name, Senior Financial Planner at CCA. I'm here today with Damien Butler from Butler Chartered Accountants, and we'd like to have a bit of a chat about self-managed superannuation funds. Damien, clearly the hot topic, or have been for a number of years now. I believe self-managed super is now the largest, has more money in it, if you like, than any other sector of superannuation in Australia. Why has it been so popular?
Good question, Dennis. It certainly is the hot topic at the moment. I think the biggest area that self-managed super fund has seen popularity grow is the flexibility of self-managed super funds. The variety of investments that can go into self-managed funds is probably a lot bigger than what they would have in the retail sector.
Property, I think that seems to be, from our observation working with a lot of clients recently, they want to buy property, say their business premises in their self-managed fund. Has that been your observation?
Yes, it has been, and a lot of our clients do have their business premises in the self-managed super fund, and that is a huge advantage to the business owners, being able to pay rent to themselves rather than someone else.
And the tax rate within super is in the accumulation or super accounts 15%, isn't it?
Yep.
Which compares favourably with a 30% company tax rate.
Correct. Yes.
And what's the top marginal rate now?
45% plus 2% Medicare if you're up for the Medicare surcharge.
So 15% tax compares favourably with 47% tax, if you like.
Correct.
I think the other issue is a lot of our clients, as you know, are moving, and we have a lot of mutual clients with both firms, are moving. There might be a business owner moving into retirement. Once if they're self-managed super fund, if they convert it from super accumulation into pension after age 55, tax rates, what is that now? Zero, isn't it?
Zero,
yeah. Correct.
So
if you owned a property in your super fund and a super fund subsequently sold it after you've switched on a pension, the capital gains tax rate is
still zero.
Is zero.
Yeah.
Which is a lot of people overlook some of these advantages. From our observation, it's mainly what control. So these are the main reasons people have a self-managed fund: control, choice of the investments,
choice of investments,
sort of transparency,
succession planning, being able to know where the super monies are going to go in the event of their untimely demise, and also putting in strategies to transfer some of that wealth to the next generation as well. And look, there's other benefits to it in terms of flexibility on how you deal with some areas of tax, which the larger funds become inflexible in terms of the way they deal with paperwork and protocol and those types of things. So I think the self-managed super fund provides a lot of key benefits, but there's some of these other benefits there with the flexibility of self-managed super fund that get overlooked as well.
No, it's a good point. I think, is it fair to say though that a lot of people seem to think that self-managed super is or provides all the answers, but indeed there's also costs and issues that they've got to be aware of. But we believe that it's probably around 150 to 200,000 would be a minimum, wouldn't it, to make it viable?
Correct. Yeah. Look, there's certainly set-up costs, which obviously costs to the super fund, and also ongoing compliance costs. Every year the super fund's got to prepare its financial statements, tax return, member contribution statements, and also have a compliance audit as well. So there's certain costs that get associated on an annual basis with the self-managed super fund, and the more assets you have in there, the more that cost actually gets diminished as a percentage of the overall funds that are held within the fund.
Look, I think one thing you can do too, if you've got a husband and wife, for example, that might have their own individual super funds in a self-managed fund, they can combine them, they can pool those assets and have it invested as one pool. Many of our clients, as we discussed earlier, do have they might have their practice or their business premises in the super fund. They might have a portfolio of direct blue chip Australian shares. They might even have exchange traded funds, term deposits, many investments which aren't as readily available, I guess, in a broadly or an industry super fund or a retail fund. What about on the estate planning, the insurance side? Are there advantages in having your insurance, life insurance, that type of thing, owned by the self-managed fund?
Yeah, look, there's a number of advantages there. One is that holding the insurance in super may mean if you're making deductible contributions to the fund that essentially the insurance is deductible from a tax perspective. Also, the payment of the life insurance through the fund to a financial dependent will mean that it's tax-free as well. And also just having the ownership held within that fund provides certainty to the owner of the insurance as well down the track.
That seems to be one of the key issues that a lot of, especially people that perhaps have been married before, where there's some legacy issues that may be concerned about. Using their self-managed fund to own insurance gives them a degree of certainty, and a surviving spouse who's effectively the other trustee or the other director of the trustee company is very much in control of the asset, rather than having it at an arm's length public offer trustee. So that's one of the other issues. If you would like to have your superannuation position reviewed, we'd be very happy to do that on your behalf. Damien, thanks for your time today.
You're welcome.